The investment climate in the UK for early stage investments has been massively impacted by higher interest rates. So higher interest rates mean that investors are more likely to pursue assets that are perceived to be less risky but are now starting to give them a higher return. What that usually means is, for example, the bank rate that a bank is willing to offer you on a savings account has gone up because ultimately the interest rate has gone up too. And that leads to investors being happy to accept those returns over potentially going down something more risky but lucrative with earlier stage investments. Later stage investments market is actually also tricky in the UK because one of the other features of higher interest rates is that there's less M&A activity. And what that smaller amount of M&A activity translates into is that there are fewer buyers in the market for companies to acquire, which means that exit events for later stage companies are also smaller. And you've also got lots of funds that are trying to raise their next fund and have not been able to do so because interest rates have meant that investors into those funds are also reorienting their portfolio to less risky assets and away from venture. So whilst it's welcome to see, from a UK tech ecosystem perspective, interest rates coming down somewhat, they're still at 4%. And that then has a significant impact on the investments that are being made into funds and the investments that funds are then able to make into companies, both at earlier stage and at later stage.